The number one thing we all want to know is when this market is going to bottom and when we could start buying stocks again. So let's jump into this market review and see what's going on. And as always, this research is coming straight from MacroOps, our global macro research and consulting firm. And you know, one of the first things we're always going to look at is sentiment. And one of the ways we look at that is with the Bank of America Global Fund Manager Survey. So this is what all the fund managers are thinking. And long story short, everyone is bearish and holding lots of cash. And what are we looking for a bottom here in the market? We wanted capitulation, right? The extremely fun word to say over and over again. But you want everyone to have completely given up on the market, because when that happens, that means they've sold pretty much everything and they're sitting on a bunch of cash. And once everyone has sold as much as they can, there's no more selling that could be done, right? There's only so low the market can go, because at a certain point, when everyone's cash is on the sidelines, there's only one option they have, which is to buy in again. Doesn't mean they're going to buy in again right away, which is why bottoms take a little while, but at least prices will stop falling because people stop selling. So that's what we're looking for, extreme bearishness. And that's how sentiment works, right? Like we just explained, if everyone is super bearish, their money's pulled out of the market, that's actually good for the market. That means the downturn is nearly over. Same thing on the opposite side. If everyone's super euphoric, that's actually bad for the market because they have all their money in there, plus they've taken on debt to put more money into the market. Then where else is more money coming from for more buying pressure? Nowhere, right? There's only one way to go, and that's down when they sell, because they only have the option to sell. So what we were waiting for in the market all these weeks is that capitulation, extreme bearish sentiment. And as you'll see now, we're getting close to it. Or we might already be there. So again, the main takeaway is that everyone is bearish and holding lots of cash. So like this says, extreme bearishness in the May Fund Manager Survey. We have the highest cash level since 9/11. That's pretty crazy. And we have the biggest tech short since August 2006. We're the most underweight equity since May of 2020. And now the Bank of America bull and bear indicator is at a 2.0 contrarian buy level. Now the only full capitulation piece we're missing is that investors still expect rate hikes to happen, because normally in a situation like this, when things get so bad, or at least people think things are so bad, they will expect the Fed to cut rates. But in this case, in this environment right now, they're still expecting the Fed to hike. So that's the piece that we're missing for full capitulation in a bottom. So stocks right now are prone to an imminent bear rally, but ultimate lows may not have been reached yet. And remember, these are all unfortunately maybes. So we got to see how it plays out. And we got more data coming too in a second. Global growth optimism is at an all-time low. And investors are just very long cash. They're short tech, and they have their lowest tech allocation, like we said, since August 2006. So you can see this chart of the cash levels right here. We're at levels right now not seen since 9/11, which is crazy. And here you can see it's the biggest tech short since August 06. And we already talked about how bad tech has been beaten up. Cathie Woods would be crying in a corner right now if she didn't make so much money off this run. So she's just fine. But the rest of the investors who followed her, maybe not so much. And it's funny, in this chart right here, you can see that investors now want CEOs of different companies to improve their balance sheets and not spend on capex or buybacks, which always changes when things turn around, right? Because the rest of the time, investors want these CEOs to focus on growth over anything else. Now all of a sudden they're like, oh wait, shore up that balance sheet. Let's make some cash flow. Things flip real quick. You can see that global growth optimism has hit new record lows, and concerns about financial market stability are at extremes last seen at the COVID bear market lows and right before the bottom of the great financial crisis. So you can see here, monetary risk overtakes geopolitical as the greatest risk to financial market stability. So again, these are all data points that we're looking at to see how extreme the bearish sentiment has become. And as you can see right here, it's becoming more and more extreme. Speaking of, I follow a lot of venture capitalists, like you know, so I get their emails and their thoughts and everything. And they are very bearish right now. They expect a recession to come. Most people do expect a recession to come. And these are smart people too. But the thing is, when everyone's expecting something in the markets, that's usually when it doesn't happen. So we talked about before how our recession indicator is pricing in a near zero probability of a recession over the next 18 months. So when I see these smart VCs come out and say, hey, I think things are going to be really bad for the next year, 2 years, that's kind of another sentiment indicator, like, hey, maybe they're not going to be so bad. And then of course it helps when you have the whole MacroOps team doing the research that actually pinpoints what's going on, so that all this other stuff can become sentiment indicators. Now, of course, in MacroOps, we could be wrong. Anything could happen. But so far, the data has been telling us that things are going to be fine. So moving on, Bank of America's bull and bear indicator triggered an official buy signal last week. So you guys remember this, we always track it. When we have extreme bearishness, it actually becomes a buy signal. just like extreme bullishness is a sell signal. So we finally triggered the buy signal here. You can see on this chart over here, we're just getting past that extreme bear red line. So we still need the tape or price action to confirm, but we've got what it looks like a double bottom on the major US indices. And that should at least be good enough for a pop, if not a more enduring low. So if we consider this a double bottom, this was the first bottom, right? And this was the second. And you can see here, if we're looking at the charts, the action on Friday was pretty good. Yeah, we didn't end up too positive, but you see this huge reversal, right? This is a very long wick. So the way you read that with candlesticks, which are very useful, is the bears try to push prices lower, but then the bulls came in and saved it. And that final print on Friday is the most important of the week, because where the market closes going into the weekend is the signal of what investors are really thinking or what's really going to go on. Because you could have a lot of noise throughout the week, but the close is what matters. So this huge reversal wick that we're seeing right here, pretty bullish. And right now as I'm recording this is before market open Monday. I mean, we're looking positive. What happens by the end of the day? I don't know. But just based off this information, it looks like a little bottom is forming. You can see the previous week, the 12th and 13th, the bottoms were again reversed. So it looks like a good bottom could be forming here. But again, we don't know if this is just a temporary bottom and if we're gonna head lower, because we could rally just like we did here and then turn around again. But based off everything we've been going over with sentiment over here, it looks like it may be more legit. But we really do need the technicals to confirm. And one of the technicals that we like to look at is breadth. So if we get a pop in the market here, we want to make sure that all the stocks are moving up together. We don't want just a few stocks dragging the index higher. We want everything moving. That gives us the signal that the internals of the market are healthy. So we haven't seen that yet. We're still waiting for it. And when you get that signal, that's when you could say more confidently that, hey, this is the bottom. And to get into some more data, Deutsche Bank, they pointed out that this sell-off is already well into pricing a recession. So the 18% sell-off we've seen this year is well beyond the usual range of around 10%. And it's gone into territory seen mostly only during recessions. So this market has already priced in the recession, if there is even one coming. And the reason that's important is because if it's priced in the recession, then you're not going to see it fall lower over recession fears. Again, you're always looking for extremes in the market, right? So if we're pricing in the recession, unless we're about to price in a depression, there's really only one way for prices to go again, which is up, because all the worst fears are already priced in. So now any semblance of good news would pop prices. That's why you're always looking for extremes. Another reality is that this correction has lasted a lot longer than your average correction, which is again another sign the market is pricing in a recession already. So normally corrections outside of recessions typically end in 3 months, but the current sell-off is already well into its 5th month and it's approaching duration seen only during recessions. So again, it's all getting priced in already. Now, Gavin Baker on Twitter, he's a hedge fund manager. He made an interesting point. And what he did was compare the difference in trailing 12 months EPS between now and the 2000 tech bubble. So back then, the trailing 12 months EPS for the 10 largest tech companies declined 73% in the 21 months post-peak valuation. But in our case today, that same number has grown 71% since those peak valuations. So it's not the same scenario. And that is a bullish signal. Now, a lot of you have commented on previous videos about the lockdowns in China. And you guys are right that a good majority of our problems, such as supply chain issues and inflation, are being exacerbated by those rolling lockdowns in China. So right now, cities that account for approximately 14% of GDP are under restricted mobility, and another 52% of the GDP is in limited mobility. But the good news is that the worst of it looks to be over for now. And if this continues, it should lift tailwinds on inflation. So things should calm down a bit. So when we relieve that pressure in China, well, things should look better here too. Initial jobless claims are putting in consecutive new highs, which indicates that the labor market is flattening out. And this is a good thing because it's going to ease up pressure on the Fed in the coming months, because then they won't be as concerned with an overheating labor market, which puts pressures on wages. And that's inflation, right? If there's pressure on wages. So what we're thinking is that the narrative pendulum has swung to peak hawkishness and peak inflation. So everyone thinks the Fed is going to keep raising rates and they think inflation is out of control. So now that we've swung to that extreme, what's going to happen? Just like in everything we've talked about, we're going to swing back. So we think we're going to see this narrative revert over the next 12 months. So again, you see the theme here. Things get to extremes and then they come back. That's how markets work. That's even how prices work. Like you can see in this stock, you'll have trend, you'll trend up higher, and then you'll mean revert. And then you'll trend and then mean revert. Trend, mean revert. So again, everything goes in those waves. One company we're looking at scooping up up is Sea Limited, ticker symbol SE. So it's fallen 85% from its 2021 all-time high, but it recently reversed off a major support and it looks as though a temporary bottom might be in. So this stock is the cheapest it's ever been while its business has never been stronger. Now we're digging back into this one because the last time we looked at it was November 2019 when it was trading for 20 something. So this is one that we're definitely adding to our watch list. But again, we might be deploying a little bit of money here and there, putting some feelers into these stocks, but we're not going all in yet. We're still being patient and we're still waiting. Even though this looks like this could be the bottom, we don't really know. You gotta be patient and you gotta wait for the tape to confirm. Because if you don't, that's when you could really get smacked. And that's the thing, we do all this research, right? So much different data and stats. But at the end of the day, you'll never catch us drinking our own Kool-Aid. And by that, I mean even when you have all this data and you really believe in something, you gotta be able to let go of it and admit that, hey, I'm probably going to be wrong. That's the whole idea of the strong opinions weakly held. That's what every great market wizard is able to do. Because what you got to understand at the end of the day is that you're not that smart. The market is always way, way smarter and it's going to do something that you can't expect. That's one of the reasons why we love using price so much, because it's going to confirm when something actually happens. And when price goes in the opposite direction of the whole thesis that we put together, well, then we're just going to drop that thesis and switch and go the other way. That's the whole reason this channel is called Fallible. Because the point of being fallible is that you're open to new information coming in and changing your opinion. You're not dogmatic and stuck to one way of thinking. Because if you do that, that's again when you're going to get smacked by the market. So that's why, again, even though the bottom might be forming here, we're very aware that we could be wrong and the market could collapse even more. And that's also why risk control is the number one most important thing. Because if you're going to be wrong 70% of the time, you better have good risk control in place so you don't lose a bunch of money when you are wrong. And being wrong 70% of the time seems like being wrong a lot, and it is. But this game is more like baseball. You need a very low batting average to actually be amazing. And in the market, that risk control keeps you in the game for all those times when you're wrong. And in this type of bear market that we're in, there is an extremely important technique that you need to be using. And we actually made a video about it right here. If you're not doing this already, you at least want to start now. It's going to save you a lot of pain and a lot of money, and it's very important. So click this video right here and I will see you there.